Hey everyone, welcome to the first installment in a range of webinars on all things commercial and growth from Bach-Andersen Consulting. Today's topic is the 2026 sort of growth agenda for boards. So it's a high-level view on some of the key themes that we're seeing across the board and what sort of investor logic a lot of boards are also bringing to the table when we talk growth. My name is Mikkel. I'm a partner at Bach-Andersen Consulting and have been working within the commercial space for quite a few years, and I'm going to be your host today. And then we're going to deep dive into some of the key themes again that we're seeing that we see shaping the board agenda around the topic of growth and go-to-market. And then finally, a short recommendation on how to get started on the transformation, covering some of the topics that we'll cover today. So the world as it is, before we go into the specific sort of growth levers, what is interesting at least to reflect a bit on, and this is based on a lot of discussions with boards and leadership teams alike, where are we in terms of the macro view and the macro world that all companies operate in? It's fair to say the last 10 years or so, quite a few companies has been sort of riding a wave of macro tailwinds, you might say, right? Low interest rates, a lot of growth, a lot of spending, a lot of stimuli even from governments. And that also meant that quite a lot of industries were actually growing, and you kind of grew not by design, but maybe by outcome, just by being in the right industry. At the same time, a lot of companies also relied on sort of excellent technologies or great products that kind of sold themselves. But we're of course also seeing that change as some of the typical distribution and product modes are also sort of falling apart. So that was sort of the beta environment where performance was sort of largely explained by where you played, not how you played. But what we're seeing across the board is this is kind of changing in many ways. First of all, capital is now constrained and expensive, so you cannot just pay out of growth or just borrow money, so to say, at least not to the same interest rates. Of course, with all the geopolitical fragmentation, trade barriers, and all these things are also disrupting a lot of things. And at the same time, we're also seeing stuff like AI and different cyclical pieces that are influencing how industries are actually growing. So we're seeing a much more uneven picture in terms of which industries are actually growing. At the same, another key driver of the new environment is of course a lot of much more volatility also on the cost piece. So inflation has been increasing for the last few years, but cost volatility is also increasing, right? So what we're seeing is a shift from beta to alpha, from playing in the sort of right industry and riding that wave to performance now increasingly being explained by how well you execute. So you cannot just rely on being in the right macro environment and the right industry. It's all up to you. So that's the big shift we're seeing. And then how do we get closer to the go-to-market piece? Well, in this alpha environment, a lot of value is actually created or destroyed inside the go-to-market organization. And why so? Well, in a lot of companies, go-to-market can easily represent 20 to 40% of operating spend. So this is, of course, a huge bucket and a huge cost item. And that also means that alpha ultimately can be destroyed or created in this part of the organization. At the same time, it's one of the least transparent drivers of enterprise value. So there's a lot of things to do here under this a little bit vague topic of go-to-market. And that's what we're going to put the spotlight on today. So, okay, where do you start? Okay, we know alpha is the new sort of operating environment where execution drives a lot of the growth and value creation. At the same time, we know go-to-market is an important piece of the puzzle, but also a very big puzzle. So how do you go about it, right? A lot of different themes, a lot of different imperatives, a lot of different places and stones to turn. But we've chosen 3 key themes that we believe are some of the most important ones and topics that we see at a sort of a board and executive levels that are increasingly resonating at that level. Those 3 are commercial effectiveness and productivity. So what are we getting out of the investment that we put into the whole commercial and go-to-market machinery? AI-first operating models also increasingly something that is starting to emerge. So AI changes the whole sort of mathematics of go-to-market. So what does that mean? And then finally, pricing and monetization also being a very, very sort of effective lever to pull if you do it in the right way. So let's open each of these up separately. The first one, commercial effectiveness and productivity. What's going on here? First and foremost, I think we need to consider where we're coming from. Revenue leaders rarely get more budget. Okay, in this environment, most revenue leaders that we interact with are sort of have a sort of a set budget that they need to operate with. At the same time, they will typically also be asked to produce even more growth for those money. So you might have a sort of a set budget, or maybe even slightly decreased, but high expectation. So what we need to ensure is that, of course, we are playing in the right part of the game board, so we are effective, and we also want to release capital that is trapped in low return activities and divert or redeploy those that capital towards more efficient means. So that's the big sort of mantra under this banner of commercial productivity and effectiveness. And there's two legs to this stool. The effectiveness piece is really choosing sort of the right race and making sure that you're actually building an engine that is tuned for those tracks. That's the metaphor, right? So we're playing the right game. Commercial efficiency is more about making sure that the engine actually converts fuel into speed and you avoid leakage or drag, right? So are we playing the game in the right way? Playing the right game, playing the game right. That's the two handles that we have put into this bucket. An interesting motion when this is a real case from a study one of our colleagues did, is that when you look at something like so simple as customer profitability, it almost always follows some sort of power law distribution, unless you operate in this very sort of simple FMCG environment where you can buy one pack of chewing gum or maybe you buy two. But for a lot of B2B and a lot of complex products, there's always some sort of power law at play. For this case, which is just one case, top 10 customers, right, out of thousands of customers contributed to 38% of EBITDA, and the bottom 930 contributed with less than 1% of EBITDA. So this very sort of diverse picture should, of course, also force us to ask some questions. Do we have the right customers? Are we investing in the right way against potential, not just size? And how good are we actually at managing our portfolio of customers? So this is a real case from a real company, but this is actually a very typical picture that we see again and again. Linked to that, in terms of effectiveness, is also making sure that we put together the right mix of engagement models that allows us to balance what I would say cost to serve and profit potential. So if you have a lot of unprofitable or a lot of customers that are not buying that much from you, make sure that the engagement model that we're also engaging them with also matches that. And the other way around, if you have some very big, high potential customers, are we providing the right level of service that allows us to maximize that potential? So it goes from maybe allocating some customers to a purely digital self-serve model or a virtual, more support-driven model, but also clarifying how those very big accounts get the best possible treatment by really firming up the account management model, the service catalog, and all those things that comes with it. So really cleaning up this picture where you match different customers' tiers to different engagement model, and in a very sort of consistent and coherent way, bring that to life is a major lever, of course, for effectiveness and efficiency. So what do you want to do about it, right? When we talk commercial effectiveness, there's a couple of things to keep in mind. Are you completely clear about where growth will come from? I think that's a very meaningful question. Also because a lot of these trends we talked about in the beginning also changing the territory a little bit here, right? So what are the big sort of value pools, the big segments that you wanna unlock? And what are the sort of typical growth swim lanes that you wanna explore as part of that map? And then again, redirecting sales and capacity towards those high value opportunities, reducing cost to serve of those less attractive ones to make sure that you actually earn money on those smaller or less attractive clients. And then, of course, align the whole coverage model, the customer economics, the engagement model, everything around that profit view. So that's an extremely important topic, something we're seeing again and again, and it's even more relevant right now because there's a shift in the landscape in terms of customers' willingness to pay, customers' potential, how much profit we're actually making from different types of customers. So all of these things also changes this picture, and it's interesting to see how few pictures that companies, honestly, that have a very clear picture of this. We'll get back to that a little bit later. That was on the effectiveness play. Are we playing the right game? Are we chasing the right segments, the right parts of the game board? Another thing is commercial efficiency, right? So when we're putting in $1 into our go-to-market system, what is sort of the return on that, right? What's interesting to see is McKinsey did some research on this. Is this can actually be quite a big variance even within the same industries. So short sort of quartile companies within same industries typically can have all the way up to a 2.6 higher return on investment in go-to-market. Very interesting. So quite a big spread within same industries. And then the question is, what do the good ones do well in order to get the biggest bang for the buck? Let's share a couple of findings. One of the sort of major drivers of inefficiency is actually salespeople and how they spend their time. In a lot of typically, especially B2B organizations, the sales salary for salespeople is actually the single biggest cost item within the whole go-to-market stack, you might say. So the time that we pay them to spend selling our products is extremely important and a very big item. But we're seeing sort of a pretty clear trend here that the time salespeople are actually spending with clients has been dropping significantly. Significantly, and is now down to less than 30%. So this is a major topic. You know, are we careful enough about sort of managing the time of our salespeople, and how do we liberate time to make sure time is actually spent with and on clients? So a short case I'll just share is some work we did with a big sanitary company where they looked at sort of identifying a new segment, creating a new sort of prospecting model within this segment. So all the way from research to defining the ICP, to defining the account list, to score those different accounts against the ICPs and developing data-backed sales plays against all those. That would typically be a massive sort of endeavor, and that alone would take up a lot of time for salespeople to do all this manual work. So what we did with this project is we actually built a tech, data, and AI-enabled solution that more or less automated the whole thing, basically end-to-end, making sure that what it outputted was basically account list where all the accounts were sort of segmented and tiered with data-backed sales play tailored to the individual company that the salespeople could start engaging. So basically taking away all the prep and pre-work from the reps so they can focus on engaging clients. And a big part of it was, of course, narrowing down what are great fit companies, and there's a lot of details to that. I won't spend a lot of time on that today. But a lot of work was, of course, identifying the right people, the right type of companies, and creating this super clear account list for the reps. And quite interesting, it again liberated a lot of time for the reps and also allowed them to engage these prospects. And it also outputted fantastic results in terms of pipeline value and return on investment compared to the investment they needed to make to make this model come alive. So fantastic case of taking away and automating stuff that can be automated, allowing them to spend time on chasing or developing clients. So what are some of the key levers when we talk commercial efficiency? A very sort of obvious place to start is to look at some of the three of the most efficient sort of non-customer facing activities, right? Which I just shared one case, but there's a lot of things that the reps are spending time on that you can easily automate or put put with the sales support team, right? So take it away from the reps, put it with a much lower cost sales support setup. So again, redesigning and automate all that work. And again, what we're seeing is easily 20% of the work that salespeople are doing could actually be automated. So there's a lot to really win here. Shift the long tail to remote coverage. We talked a little bit about that before, but again, you will probably have 25 to 50% of your accounts which are small, low growth, low profitability, that are getting the same treatment as some of your big ones. So here, there's again a huge opportunity to creating a much more sort of digital, low-cost engagement model that matches the profitability potential of those segments. And then, of course, much tighter performance management. That's something we're seeing again and again, that the whole steering rhythm is very, very firm, allowing us to make sure that we're investing towards the right segments, but also making sure that we're operating in an efficient manner. And then systemizing capability development, a big topic as well, making sure that you're constantly looking at where we're not performing across the funnel, and then doing bespoke training and capability development focused on closing those different gaps, so we're constantly improving. AI first operating models is the second topic that I'll cover as part of this presentation. Of course, this is getting a lot of boardroom attention. We're also seeing a lot of sort of LinkedIn chatting about are we all being made redundant and all these things. So hopefully I can provide a little bit of a grounded view on this. But I see myself as a realist, a little bit between the overly optimistic ones, and the pessimistic ones in terms of what AI can actually do for commercial organizations. Because actually, when you look at the research, we get a little bit mixed signals here, right? Because a lot of the companies that are actually investing in AI are sort of reporting that they feel like they're getting lukewarm results, and it's difficult for them to sort of actively measure what the output is of these investments. So that's sort of a broad stroked observation that a lot of different studies have replicated. But again, when you sort of zoom in on some of the leaders and also some of the companies we work with, it's very clear that there is a part of the pack here that are seeing extremely high returns on AI investments, right? So you have a bit of a mixed picture, right? Average looks a bit lukewarm, but when you zoom in on the 10 or 15% that are actually doing well, they are seeing extremely sort of positive outcomes from AI investments. So that is a reflection. There is no one-size-fits-all model. There's no benchmark here. It really depends. What I personally believe, I think, is that one of the biggest changes that we're starting to see is that where AI, since sort of ChatGPT was released 3.5 years ago, where the last the last 3 years has really allowed us to put AI to use at an individual level. So it's largely a tool that empowers those curious individuals to do more, do better things. What is also very clear from a lot of the research is that adoption is, again, also varying a lot. So it really depends on who you are as a person, the curiosity, and the type of work you do. So AI is being picked up in a little bit of a random manner across the organization, empowering individuals. So yeah, a lot to be gained, but mostly at an individual level. So what we're starting to see now is that the value and the adoption is starting to sort of become sort of structured when AI is becoming an embedded part of the operating model, not just the tool stacks of certain individuals. And what is happening? One thing that is pretty clear is that more and more of the execution layer in the commercial organization is getting sort of handled by either agents or extremely capable AI assistants, right? So yes, there's going to be some sort of human intervention, but a lot of work is being taken over and increasingly done independently from human oversight at the most basic execution level. So AI is not just a tool anymore, it's increasingly becoming part of the operating model. And of course, this varies depending on where you sit in the commercial organization and what you do. Not all tasks are fit for agent execution and all these things, but it's a pretty sort of a consistent picture. What that also means is humans becoming more of an orchestrator, strategizer, and sort of a judgment layer, right? When the actual sort of report writing or manual research or basic messaging work is taken over by machines. Humans can do a lot more work, and also the role of what humans actually do is of course also changing. So AI becomes sort of the operating layer. It probably also means, I think, at least medium term, that we'll probably see a little bit of fewer people employed, or maybe we don't see as big an uptick in hiring as we would expect, and value increasingly captured at system level, not just among some of the sort of sporadic super users. So this is the interesting shift that we're seeing, and then we can discuss use cases and how to embark on this transformation for ages, but I'll leave that for another time. Interestingly, I think the interesting thing when you look at AI in commercial ops is really what are some of the key questions that it's triggering. It shouldn't just be about, hey, what's the use case? No, it actually allows us to entirely rethink some of the key workflows that I think we all grew up with, right? At the same time, decision-making rights also shift a bit, because where must humans really retain control, and what, quote unquote, can we outsource to agents and assistants? It also, I think, should trigger some sort of reflection on what are the right roles that we need to do. And within those roles, if a product marketing manager is moving away from being sort of the wordsmith of the messaging to much more of a orchestrator and a judge, does that also change not just the role itself, but also the skill matrix needed to succeed in that role? How does it fit within the sort of classical structure of sales, marketing, and customer success? Where should it sit in the organization? Does it change some of those silos and functional units that we are sort of all used to, good and bad, you might say, right? Who's accountable to outcome when machines are starting to run some of the key workflows as well? How does that change, of course? And then make sure that when we're moving to system level from individuals, how do we actually track the impact ultimately? Cost to serve, revenue velocity, margin, whatever we're looking at, how does it materialize in terms of benefits at a system level? So that's, for me, some of the interesting things that should trigger some introspection, not just, quote unquote, which use cases should we explore, but some of the more systematic stuff here, extremely interesting. Final topic is pricing and monetization. And why is pricing and monetization interesting? It's one of those things where just a small change in terms of how much we charge, for example, can really yield a massive benefits. So it's most, I think, a lot of research has been done on this. It's the most impactful lever that if you, for example, are manage to raise prices without losing clients, it's by far the one lever that translate most directly into increased profit. So of course, pricing, monetization is interesting. I also believe the agenda is shifting a little bit, and I'll show you how. The last 5 or 6 years, this pricing and monetization agenda have largely been driven by, I would say, closing the value price gap that a lot of companies had, where they were charging much less that they were actually than the value they were creating. So we've looked at cases in our company as well, where a lot of companies could easily raise prices with 20 to 30 to 40% without having higher prices than competitors. Stuff like that is just whack, right? So a lot of companies has been closing these gaps. There's also been sort of general price increases on the back of increased inflation, of course. A lot of that has also been passed on to clients. But where do we go from here, right? Our research also show that a lot of clients, like customers, end customers, are sort of rejecting additional price increases that are not matched in any way by any equal step up in value. So I think the new frontier is also reflecting a little bit about, it's not just about increasing prices, it's about 2 key imperatives. Those imperatives are the following. We need to make sure that we have sort of really on top of what we charge. So how much are we actually charging? I'll get back to what that means, but also how we price. That's more about the monetization, packaging, and pricing model we deploy. Not sort of how much it should cost, but how we price it. Extremely interesting. Those two different pieces require different skills and imperatives, where the first one is really about understanding, transparency, and discipline. The second one is more about innovation, creativity, and experimentation. So two different paradigms under the umbrella of pricing and monetization. Let's unpack each of these. What to charge? Well, what is very sort of evident is that we need to continue having very high discipline under when you look at this topic. Why so? Well, what we're seeing across the board is increased professionalization of procurement. So buyers are negotiating increasingly harder on price, terms, value delivery, all these different things that can really, really tank profitability. At the same time, we've seen a lot of sort of volatility in commodity prices, right? So if you're not on top of how your margins are developing, you really risk having a lot of unprofitable clients. That's something we've seen also in the work with clients, that you have a lot of clients that incrementally lower your profitability. And then a lot of research has been done that if you're on top of these things, you can really, really unlock a lot of profit potential. But it requires a few things here. You need to have deep insights into willingness to pay. So that's the client's ability or willingness to pay. You need to understand your customer leverage. In what positions are we? How sticky is our product? How dependent are the clients on us? And that, of course, it also influences our ability to charge more. But also cost to serve, that's more the cost dimension. So do we have unprofitable clients, honestly, or segments that we're serving? And again, we're leaving so much money on the table here, especially if you are sort of one of these complex manufacturing companies that have a very broad portfolio and a broad tail of customers. So again, some of our colleagues did a project, and one of the things that was very clear from that project, as an example, is how a big variance in price there was among customers buying exactly the same product. So this is sort of a view of that, and you could see that at least 40% of clients were paying below benchmark. For no meaningful reason. It just happened due to lack of transparency and discipline and governance. A very high variance, customers buying exactly the same product. A very typical finding when you do this type of research. Another type of sort of finding, also when you can run as part of these different projects, this is also a case, is again where you have a lot of certain clients you have a lot of leverage against, right? They are dependent on you due to your supply position, the breadth of products, your proximity to clients, or whatever. A lot of different factors can go into leverage, and of course you should define that. But the key is here again, a lot of customers where you have a lot of leverage are still charged way too little. So again, using that leverage to charge more is an obvious intervention also to do in order to ensure that you get the maximum price without losing clients, of course. So using leverage as another lens of analysis and intervention points also extremely meaningful. And then again, another type of analysis also from a case where they looked at different customer groups, where you can look at different segments within that customer base, and where a lot of the clients in the different cohorts were actually either contributing with less than 5% contribution margin or flat out negative, right? So we're losing money from having these clients. We would be better off by not having them if we're optimizing for profitability. Again, a huge variability depending on how you're set up, but getting this type of transparency is extremely, extremely powerful and allows for you to design some really, really impactful interventions. That was the discipline part, right? So what do you need to focus on? Well, start with the sort of economic diagnostics, not just sort of price moves, right? Do you have a clear picture of margin variance across product segments and channels? Where's the discount leakage, right, versus the price list? Do you have a clear picture of cost to serve compared to different cohorts? And how great are we at realizing our prices compared to what are the customers actually willing to pay? So that sort of diagnostic piece extremely important. And then design these different types of interventions where you are either letting go of clients, you are increasing prices on certain segments, you're restructuring or downscoping whatever services you are providing in order to make segments profitable, whatnot. There's so many things that can be done based on the initial diagnostics. But then finally, creating an engine where transparency and governance is the default mode. It should not just be a project. It should be an ongoing dynamic capability that allow you to constantly track these different things and then intervene in timely manner, so to say. So a lot of things to be won, again, under this umbrella of disciplined charging, so to say. On the how to price, how you price is less about how much, but more about how and the monetization design, the pricing model that you apply. Why is this interesting? What we're seeing across the board, and especially coming out of software, is that there's a lot of new models being tested. But honestly, it's not just about trying something else. It's also about making how you price your things a key driver of differentiation. Because it's, again, product and distribution advantages are being increasingly eroded. So working with monetization design in a creative way can be an extremely impactful lever, not just to earning more money, but also in order for you to stand out from competition and actually get the deal. And without this, what we typically see is that you just default to price increases and your sort of fixed and classical discounting cycles where you typically get in some sort of procurement-led price discussion. So really, it can be extremely powerful if you do this in the right way and help differentiate your offer and ultimately get the deal at a higher price, of course. And again, a lot of work is being done, especially in software, where you're seeing an increasing uptick of usage-based and outcome-based models. But it's not a software-only agenda. There's so many things that can be done here. What we're seeing across the board is a lot of companies, even hardware companies, are also increasingly becoming service companies or adding different types of supply chain solutions on top of the raw material, or the raw product that you've been offering. And all these things that you're adding on top of your sort of typical hardware product also allows you to be creative in this space. So a lot of things to be won by experimenting and being creative and innovative within the space. So what do you need to do to bring it alive and get the most out of this bucket of potential? Well, first of all, you need to treat it as not just a project or something you do one-off. It's a very sort of ongoing activity, right? And it should be baked into how you think about products and how you think about go-to-market and how you position your product. This is a very sort of essential capability to keep an eye on when you're bringing new products and new solutions to market. And it should never just be default to whatever you've done before. It should be intentionally designed. Another thing is to keep sort of learning. So this is not just a project. There's so many things that can be done around different pricing and packaging models and all these things. So keep piloting new things, testing things out with new segments to see whether things take off and of course, hopefully contribute with positive unit economics. So instilling some sort of experimental approach is also, I think, important also with all the new things and new models popping up and changes in the customer's appetite for these models as well. And then, of course, also keeping an eye on if you do any types of intervention or experiments here, are they actually moving the needle in terms of why we win, right? When you talk to a lot of salespeople, sometimes you get the impression that we lose a lot of deals because, well, the price was too high. If things were just cheaper, we would have gotten the deal. But Sometimes it can actually be the monetization, design, packaging, and pricing model that is holding you back from getting the deal. So yes, a lot of innovation can be done, a lot of differentiation, but it can actually also move the needle in terms of deals you of course win. So extremely important topic, a little bit of a different paradigm, more about innovation, creativity, testing things out rather than pure sort of pricing discipline. So before we go to questions, maybe just a short reflection on, okay, I shared 3 topics. We talked a little bit on the beginning about the sort of the environment we're in, where we're moving from a beta to alpha environment where we are masters of our own fate. Growth is not something that happens to you. It's something you deliberately design. That's why I think it's also important to say this is a board level topic. You cannot relegate this to a CMO or chief revenue officer. This is a board level topic. A lot of money are being spent in this area, and a lot of things to be won. So where do you start? Sourcing from some of the things we just discussed, I think there is a sort of a very simple way to look at it is to look at 3 things. Key question number 1, where will growth come from? Are you totally clear on that? Segments, swim lanes, different products, what markets? Do we have a clear picture of where we believe growth will come from? 1. 2, can we articulate how we are gonna set us up to win that growth potential? So basically, how do we grow, right? Commercial structures, engagement models, channels to market, coverage model, resource deployment, right? Whatever needs to be in place in order for us to win those growth pockets. And then finally, the discipline, incentive system, processes, all these things that need to be in place that allows us to execute and dynamically sort of steer this growth plan. So where will growth come from? How do we capture that growth? How do we steer and execute that growth plan? That's the 3 pillars. And then there's a lot of things below that, and depends on the industry and maturity and all these things. But those 3 questions are pretty good sort of guiding arrows that will allow you to look at with sort of a board level and leadership level, fresh eyes on how to design a system that allows you to deliberately grow, not just let growth happen to you. I think that's it for me today. So we're going to send out the webinar and you can view it on demand. That was also one of the questions. Thank you and have a great day.